Hey everyone, welcome back to another episode. This is another deal analysis, but it's going to be different from all the ones I've been doing the past couple months on the podcast. So today we'll be talking about a portfolio of 6 fourplexes in Wheat Ridge from a different perspective, because my guest today is Terrance Doyle. You guys have seen him a lot on the podcast, and you know the last couple of years he's transitioned from single-family flipping to doing multifamily stuff, and now he's really upped his game even more to putting together bigger deals and in ways in the syndication as well. So it's very interesting to talk to him because A, it's in Denver. B, this is a deal that's happened in 2020, so recently. We talked about some COVID stuff. And also, I'm getting more interested myself in taking some of my money and doing some more passive investing as well. So I want to start learning more about this side of the world, about how they structure it, the returns as well. So Terrance, I'm glad to have you here, man.
Chris, thanks for having me.
And then we got another guest here, Ben Davis, who's your CFO. Correct, right?
That's right.
All right, Ben. Well, glad to have you here. And I forgot to mention, your company is the Value-Added Real Estate Company, or VareCo for short, and that's what you're doing all these deals through now, right?
That's right. That's kind of our branded name. The thinking is everyone talks about wanting to be in value-add deals, and we feel like that's what we know and we do really well, and that's how we branded ourselves.
Cool. And so, for everyone out there, this will be the first of many podcasts. We're planning on doing quite a few with Terrance and Ben and their team, and just talking about the structure. So if you guys listen to this, you have feedback, you have questions, reach out to me. We want to make this better because we have a lot of different numbers we'll be talking about in here. I want to make sure that we can try our best to communicate clearly. Now, we will have some screenshots to some numbers in the show notes if you guys want to reference some of the numbers we talk about. If you got specific questions, though, always reach out to me and we'll get you the full details. All right, guys, so jumping into this, what is the background on the property and how you got it?
Yeah. So basically, so many people reach out to me, and I'm sure you, every month, and they want to know, how do I get into multifamily? Maybe they've done 1 or 2 flips or have a couple rentals, or they have a duplex, they've house hacked, and they're like, how do we take it to the next level? And I was the same way in 2017. And, the punchline, from my experience is just relationships. People say that, you can only get deals through brokers, and, I don't totally agree with that. But I think you have to get deals through relationships. I think you can do the mailer route. I think in Denver, that's really difficult to do. And it doesn't necessarily have to be a broker, but it's relationships. And this deal came about through a relationship that I built 2 years ago with one of the top, and I would say senior level multifamily brokers in Denver. He's been doing it for 20 plus years. And he's either sold a lot of the deals or sold them to, the family members of the, that own them. And on this particular deal is the same thing. He helped this guy get into a couple different properties, and then the property manager called the broker and said, hey, I'm going to sell this for the owner. Do you have anybody? I don't really want to list it and go through the whole dog and pony show and have a bunch of, especially during COVID, have a bunch of showings and have to get potential buyers in. Is there a way that you have, we can just make 1 or 2 phone calls and put this under contract? And he called me, and we had it under contract 24 hours later. So that was, so the long and short of it is, it's someone that I've worked with a long time, and this is going to be the first or second deal that we close in 2 years. So a lot of patience, a lot of time spent looking at other deals, and this one, fit our box, and we were able to get it done.
And that's something, we preach about. We're a broken record on
right.
Patience and the long game a lot, so that's just another great example. So going back to relationship, because I think there's a big difference of if you're going for, multifamily versus single family. I'd say, from my experience, a lot more multifamily definitely trades through hands or brokers.
Right.
Where single family, a lot of times, it can be like, hey, direct, contact the distressed owner or go through a wholesaler.
Right.
But I think a lot more multifamily goes through brokers. Is that what you've been finding, too, in your deals?
Yeah, 100%. I think that just the nature of commercial is that there's a small number of people that control the relationships with the sellers, just because there are fewer number of commercial properties in Denver. And so there's a fewer number of people that have those relationships, have those databases. And yeah, is there a needle in the haystack, and could I send out mailers and do cold calling and try and get them on the phone? Yeah, but I think, if I just focus on what I do best and double down on my strength, which is construction, execution, and the capital, I can let someone else focus on building those relationships and just calling me when they have a real seller that's ready to sell. And so, yeah, when we were doing single family, there was, we did mailers, we did door knocking, wholesalers, auction. There's so many ways to do single family. And I think multifamily, especially in a city like Denver, very dense, rapidly growing, with price appreciation like we've had, you're just very unlikely to find a needle in the haystack with someone that doesn't understand the value of their property and is going to respond to a cold call or a mailer. It can happen, and it has happened. I just think, I'm going to play the percentages and play to our strengths and rely on people that do that full time.
And plus, that's what a lot of brokers do, is they make 300 cold calls a week to develop those relationships, and that's
100%.
Yeah, they're doing that. So it sounds like this broker, he helped them buy the property years ago.
Right.
He sold it to them as like the buyer's agent.
Or a family member. He had done multiple deals with this owner and this property manager, and then they knew that he was a guy that they could trust and knew had buyers like us. And they, when they were getting ready to sell it, they called him. And then I think he on the phone he told me, this is the guy that I trust. He said, "You're my first phone call. I think this is going to be one of the best deals we do all year. I know this fits your box. Why don't you take a look?" And the backstory to this is in 2016. I had bought my first fourplex actually on this same street down the road about 2 miles. So I knew the area, I knew the tenant class, and I've done a bunch of fourplexes obviously since then, so I understood the construction, and I knew the value of that. And basically the value that we sold that one for in 2016 was $795,000, and it was a fourplex actually smaller than this. So he calls me, and I already knew the address, knew the area, had experience in this area. And when we talked about the deal, and we'll go into the numbers on the rents, but when he started talking about the rents, it was just a no-brainer because I knew the area. So then we made an offer really quickly and put it under contract. Okay.
And what's the from a high level, like what's the property type? Like what's the unit mix? What's the layout? All that.
They're 2-bedroom, 1-bath units. So it's 6 fourplex properties, and then one of them, one of the units has an extra basement. That's a 2-bed, 1-bath, so it'll actually end up being 25 units when we're done with it. But it's currently 24 units, 23 2-bed, 1-bath. They're roughly 780 square feet, and then one of them happens to be 1,600 square feet, and it's a 4-bed, 2-bath.
Oh wow!
But they're all built the exact same. There's actually a little carve out of land about half an acre behind it that comes with the lot with the property as well. So it's just they're all strung along. It's just 6 fourplex buildings and then some land, on the same plot.
And these are, I've seen some photos. These are just the typical 2-story all brick fourplexes that are pretty common around Denver, right?
Yeah, that's right. Just straight, just right down the middle of the fairway, fourplex brick. Some of them have some newer windows. There's a common area, behind one of them where we think we can do a playground or something like that for kids. So yeah, just 6 fourplexes with patios, all kind of in a row.
And then they're all together on one lot?
One parcel, that's okay. Right. That's right.
And then do you want to go into numbers? I don't know if you closed the deal or not, but you can go into numbers as far as what you've offered negotiating? Okay.
Yeah, so we put it under contract at $3.85 million, and which was roughly 160 something a door. Ben can give us the exact numbers here in a minute. But then we did our inspection. And after inspection, we were able to get a concession of $60,000. So we're going to be just under $3.8 million for 24 units.
That's a really good deal. So you put it under contract. What's the kind of going into the due diligence? Because I know you guys are you have your high level sniff test, I'll say.
That's right.
You act fast, you put it under contract, but you always do your due diligence. And what was your plan for due diligence on this portfolio?
Yeah, I'm glad you brought that up. So, part of, like you said, is you got to be able to move fast. I think I've talked about that a lot. You build relationships, for so long, and then someone calls you. You got to be able to move and react quickly. Otherwise, they're going to call somebody else. So we did that. And then after that, then Ben and I kind of get to work on our team on underwriting and doing, so a full rent study. But the first thing we do is we schedule the inspection. So once we're under contract, we have an inspector that specializes in multifamily, and he comes out and inspects the roofs, the plumbing, the electrical, the foundation, every single sewer line. So this has 6 buildings, so 6 different sewer lines that connect to the main. He checks the gutters. I mean, every square inch of this places that I don't even care, crawl spaces, every single thing, he's going to check out. He's going to take pictures and do a full report.
So you're doing a full inspection?
Full inspection.
Because I know your single-family flips, you used to just do a walkthrough and sewer scope, basically, right?
That's right, because basically they end up costing between $600 and $800 a building. So it's pretty expensive. This is 6 buildings, so you can do the math. It was $4,000 or $5,000. So it's a lot more expensive, but because the dollars are so much more, and because we're going to have other people's capital at risk, and I think that was part of the difference. Is when we're doing single family, it was all my company's capital, didn't really have anyone else's capital at risk, and I could just walk in there with my GC and we could check everything ourselves, still do a sewer scope, but we'd have the electrician check the electrical. But this time I hire someone that's a licensed inspector, and he goes in there and investigates every square inch, trying to uncover everything about the property, and then parallel to that, we order an environmental, a phase 1. And Ben and I laugh about this because it seems like overkill, but again, when we're having other people's capital at risk, we want to uncover every stone and basically leave nothing that's been unverified and checked out about the property. So we order a phase 1, and really the phase 1 is going to tell us everything that this property has been since Denver has been, since Wheat Ridge was this zip code and this address. So it's going to go all the way back to when this became a plot, an address, its own parcel, and it's going to tell us everything it's been every 10 years. So I can see when it was farmland, and then when I see when they first pulled the permit to build it, when it was built, and different improvements they've made, every permit that's been pulled on it, everything that's been done in the area within like a 5-mile radius. And so it gets pretty into detail. It's actually a 142-page document, a phase 1 environmental is.
And you make Ben read all that?
We go through it together. It's kind of algebra, and then you hire an attorney to read through it and tell you if you missed anything. But Ben and I actually did read every single page, just because this is maybe the third one I've looked at. From my previous life when it was just my own capital and doing single family, we never had to do a phase 1.
And you're doing this is just for your own due diligence for basically your investors, not because it's a lending requirement, right?
That's right. We're doing it for our own due diligence.
Okay.
That's right. Yeah. So it's it's on our checklist, right?
It's going to have fault line information, the density of the soil and everything. It's going to tell you basically from the ground down.
Now, they actually go down there, because I know there's different environmental studies, and I'm not an expert in those. Are they actually taking soil samples, or is this all just like the history of it?
The history, and they do take soil samples.
Okay.
So it goes into different phases, but on this one, they don't have to go, they're just going 20 feet, and I think on other ones, they go even a lot farther. Okay. And they're checking more than that. But yeah, this one talks about 20 feet, basically down to the water level.
Okay.
So.
And anything pop out there that you guys weren't expecting or out of the ordinary on the environmental report?
Because this property has only ever been multifamily, there was nothing that was found. It was kind of interesting to go back and see, in the 1950s and 60s what Wheat Ridge looked like. And so that was educational for me. But it's basically only been an apartment. They pulled permits to do some sewer work, to do some electrical work, and to do, I think, the roofs 10 years ago. So that was, so you learn what they've done and how many times it's traded. This property hasn't traded. This will be the first time it's sold. So you kind of learn some different things about that. Yeah.
Okay.
Yeah.
Because these were built, in the 60s?
62.
Okay.
Yeah. So it's, I think part of what I enjoyed reading them is, when our investors ask me about the property, I think I know more than I need to now. But it was interesting and educational, and I don't know how many more of those I'll be reading from front to end. But, it's just part of due diligence and making sure that we're thorough and that we're, have all the data points that we need to make the right decision. So that was part of due diligence. So we order the inspection, we order the environmental, and then we do a rent study. And a rent study, and we've talked about this on multifamily, basically means we drive the property. We're going to check everything within 6 and 12 blocks around it. See, if there's, what restaurants there are to eat, if there's any shopping, schools, transportation. Is there anything substantial or significant, within walking distance or within, 1 mile of driving. And again, since I had done a multifamily project, really on the same street a couple years ago, I kind of knew about the area. But there's been a lot of, just like in all parts of Denver, there's been a lot of development in the last couple of years there. They actually took down a Ford dealership on the corner down the street, and they've redeveloped that into some mixed use and some restaurants. So it was great for me to drive down and see that. And then I pull up hot pads and Zillow and apartments.com, and I'm basically going to go on and try and look at, what are the 2-bedroom, 1-baths in this area, similar condition, and what are those rents. And, I pulled up, I think, Ben, we did like 10 of those.
And we've got, because I know for a lot of the people listening to this, we've got your memo here with a summary on here. And is this something we take a screenshot of and put on the website, just the rent study? Okay.
So there's some of the rent comps. So there's an address there.
So explain this to me, because I have not read this memo in detail. So because I know this is just a summary page for your investors, but kind of walk me through it.
So basically, I'm just looking at what are the similar properties that are direct competition if I'm trying to rent this, that I can use as data points to understand what I'm going to rent this for conservatively. And conservatively to me means, if there's rents that are at $13.95, then I'm going to try and say that we can lease it for $12.95 or $12.50, right? So within 5 to 10% under, so that I know that we can get. And so that's what we did here. So I pull up the websites, and then I drive the properties, and I see, okay, there's a property here, 1 bed, 1 bath, 850 square feet. So ours is a 2 bed, 1 bath, but it's about the same square footage, same build.
So do you go, because I noticed the 3 on this page are all 1 bed, 1 bath, but you mostly have 2 bed, 1 bath. Are you more focused on square footage or bed bathrooms?
That's actually that's a kind of a tactic that's kind of insinuating, look what this person's getting with a 1-1. We have a 2-1. So because of that, it should be clear that we could get at least this rent, and obviously because of another bedroom, we would want more.
So this is like your conservative baseline.
That's right. That's why those are highlighted in an investment memo, because it's showing a potential investor, the rents that we're underwriting can technically be achieved in a 1-1. So that the investor should see that and feel really good about renting a 2-1 at or above that price is the reason those are 1-1s.
Okay, that makes sense.
That's exactly right. It's like if they're getting $12.95 and $13, like on that second one there, it's smaller, 1 bed, 1 bath, and they're getting $13.95. Now that one on the interior has washers and dryers, right? And so I do that. I list all the amenities and kind of compare them back and forth. And then you can look at the kitchens there. So it's outdated cabinets, outdated countertops. Those are just ceramic countertops with a yellow fridge and a white stove. So they're getting $12.95, 1 bed, 1 bath, 700 square feet. So to Ben's point, we can look at that and say outdated, 1 bed, 1 bath is getting $12.95. The other interesting thing about this is there were very few 2-bedroom, 1 bath unrenovated that I could comp. So when I called the complexes, they were full. So some of these properties had more 2-bed, 1 bath, and they had a waiting list for those. So then we put that as a data point that there's not a lot of 2-bed, 1 bath inventory available here. And if there was, then this is what they're getting. So it also goes to show that there's a need for more 2 beds. And this complex that we're purchasing is full as well.
Okay. And then so the 1-1 comps for, I'd say, pretty, looks like from that 1 interior foot, pretty standard rental grade stuff in Denver.
Right.
Actually probably a little bit nicer than a lot of stuff we see out there. You're looking at $12.95 to $13.95 for that. And so you guys underwrote yours at, what did you underwrote it at, and what do you think it will get?
Yeah, so what we do is, we look at the current rents. So the current rents for the property are $944, right?
On average
across the board, $944. So immediately, I knew that it was low because 4 years ago we were renting 2 bed, 1 bath for $12.95, but I want to confirm that and verify it and see if things have changed. So then we do the rent study and we realize that pretty conservatively we can get $12.95 to $13.95. So what we underwrote it was $11.95 plus 100 in rubs, and the rubs is the bill back for water, sewer, and trash.
You underwrote it that low?
That conservatively.
Wow. Okay.
Yeah, and that's just to say, hey, we just went through a global pandemic. The next year could be rocky. The next 2 years could be rocky. We don't really know what the workforce housing situation is going to be like. We don't know if COVID's going to come back and there's going to be a second wave and there's going to be more unemployment. So we're trying to be very conservative, and that's really what our institutional investors are looking for is, hey, if worst case, if shit hits the fan, what can they really get? What can we? What do we have a level of confidence, a high level of confidence they're going to be able to rent? And that's $11.95 plus 100 in rubs. And what we'd like to do is then we'll perform. We'll go in there and do some construction, renovate the units, and most likely we'll come back and show our investors, hey, not only did we beat it, but we beat it by maybe $150, and now they're even getting a better return than what they had projected. And that's the goal, right? Is we'd much rather do that than tell people we're going to get $13.95 and then something happens and we're getting $12.95 and then when you raise people's level of expectation, even if they're getting a double-digit return, if it's $100 less than what they thought they were going to be getting across the board, they're going to be pissed off versus now it's going to be a lot more than what they thought they were going to get, and they're most likely going to be happy.
Under promise and over deliver.
That's right. That's a simpler way of saying what I just said.
So did you underwrite this? Because I know you always underwrite things conservatively. Did you underwrite this more conservatively because of COVID? Or how did that factor into there?
For sure. Absolutely.
Things were kind of just scary in April, May, like no one knew what was going to happen.
It's pretty wild, yeah. Very uncertain. Yeah, I mean, banks, the amount of scrutiny that banks and investors are giving us and the questions they're asking, we have to be conservative. And we can talk about financing. Ben can go in that a little bit later, but Yeah, absolutely. We wanted to be conservative for the bank and for investors so that they have a high level of confidence we'll be able to hit our target.
Okay.
Vacancy is the best mechanism to underwrite, a pandemic or your prediction on the market for the next 5 years. That's the best way to throttle that.
And do you remember, like, when you were looking at this portfolio, what was the vacancy and how many late payments were there on the portfolio on average?
Yeah, that was definitely something we asked the property manager, and his response was basically, we've had no vacancy. It's been, the average occupancy has been 98% the last 5 years, right? And the reason they have that is because rents are so low.
Yeah.
So that was his thing. Is this owner's owned it for a long time? They have virtually no basis in it, which means there's virtually no debt on the property, and so his goal is just he wants mailbox money, and so he just wants a number that he can keep it always have it full, and that's what they've done. So through the pandemic, they've collected, I think, 98% of rents, and they've had one move out. Someone moved to Florida, and then that unit was filled the very next day. Like they had a lease signed. So, and it's not a surprise that in this, 944, when we're seeing these comps at 12.95 and 13.95, it's no surprise that they're full.
And so, I know a lot of times, 5% is a common underwriting number for vacancy for banks. What, when you were underwriting this, Ben, or I was talking to banks, like, were they using actual vacancy or were they using higher vacancy?
They're using actual.
Okay.
They'll look at his actual or the seller's actual.
Okay.
And so they're not gonna lend to us based on 2% vacancy loss, which would be, what he's been achieving. So we'll underwrite usually 8 before we do construction, and then 6 afterward. It's kind of standard for what we're seeing.
And then I want to go, before we actually jump in on the financing stuff, look at my notes here, I want to talk to you about the inspection items.
That's right.
Because I know you did your full inspection.
That's right.
What came back as, like, with the inspection, obviously, like the major items? A lot of stuff, like it's cosmetic, you probably don't really care.
Right.
But major stuff you care about.
Yeah, so, again, it kind of goes back to empathy, like putting myself in the seller's perspective. The last thing you want to get is a laundry list for an inspection item and then try and get ask for a big concession. But based on the conversations we had during the inspection, they were under the impression that the roofs had just been done. And I think the comment that we got was they had been done in the last 5 to 10 years and they were in good condition. And so one of the big things that we focused, so when the inspection report came back, there was some electrical that had been outdated. And naturally, because this building hasn't been renovated, there was a lot, the soffits and fascia, the roofs, the gutters, some of the electrical panels were outdated. The sewers were actually in really good shape. And
they're the original sewer lines?
Original sewer lines.
Wow.
They had been repaired, I think, in the last, maybe those had been repaired, actually. They had permits and they had, that's right, had some repairs and cleanouts. So the big surprise was the roofs. All the roofs were in bad shape. All needed to be replaced. The gutters mostly needed to be replaced, and the soffits and fascia. So there's a lot of work. I think close to like $150,000 just in roofs and that exterior work. And so we did, you get the roof report back. You get the report from the inspector, and then I send my roofer out there, and I have him give me an official bid with pictures, with pricing to show. So once you get the report, and same thing, we did the same thing for the electrical, for the plumbing, anything that was a cause of concern for the inspector, we went out, we sent our vendor out for that particular trade to go out and give us a bid. So we get those written bids with the pictures and the inspection report, and we submit those as part of the inspection objection. And then there's kind of some horse trading back and forth between the seller and us. And we landed on $60,000 that we were able to get as a concession based on the condition of the roofs, primarily.
And I'm guessing none of those were like hail damage insurance claims?
They hadn't filed any claims, and they hadn't really done anything to it. And that's what I think what was surprising is they thought they had. And I think when they got the report back and they see the pictures, and it's very unbiased. It's not like we can fabricate that. It's from third parties that, they have licenses, so they have to, tell it how it is. So I think they were surprised too, and it was just from lack of, it was from not, I think, just being kind of absentee, and for whatever reason they hadn't filed insurance claims. And, with the 4 seasons that we get in Denver, that's not uncommon to see on shingled roofs, and so that's kind of how that's kind of where we ended up, and so we spent probably $6,000 to $7,000 on the inspection, on all the reporting, and then we're able to get $60,000 back. So that's a pretty good. We felt really good about and where we ended up. Obviously, we're going to spend more than we thought, but we're buying the property we feel like is a pretty fair basis. So that we felt like that was a fair compromise with the seller.
And even if you get anything back, I mean, expecting a few $1,000s in due diligence, that's worth every dollar you spend on that. So you either know to terminate or you truly know what you're getting into.
That's right.
Okay, so the main thing here, you said sewers were in great shape.
Sewers are in good shape.
And everyone out there, always do a sewer scope, especially for all these 1960s buildings. They're clay pipes,
That's
and
right.
they settle, and the roots get in there, and it just happens. So the roof was the main thing, it sounded like, though.
Roof, there was some electrical stuff we'll have to do. Some of the...
Was the electrical stuff, that's just like...
Just outdated panels.
It's outdated
panels.
It was
Nothing.
Up to code in the 60s, but
right.
now it's just
been outdated. Yeah.
Okay.
So, and they could support all the appliances, so there's no real issue there. It won't be really an issue with rents. We'll see. With this in this neighborhood, I don't think we're going to need to upgrade and offer any additional amenities. So the electrical will be fine. We'll make some minor repairs there. The plumbing was pretty good. There's going to be the boilers were in good shape. The water tanks were bad, so we'll have to add some new hot water heaters.
Are they all individual water heaters?
Individual water heaters.
Okay.
Yeah. Other than that, there was nothing really that they talked about. Some of the brick had settled a little bit. Nothing bad. We'll do some tuck pointing, and we like to paint brick anyway, so we'll come in there, tuck point, and paint them, and give them some life. So a lot of the other stuff was just cosmetic, and we're going to be updating these after we purchase them anyway. So there was nothing else really alarming.
Do these have in-unit washer dryers?
They don't. We think we might have some space to do that. Basically every building has its own washer and dryer in the basement.
Okay, per building.
Per building,
okay.
Yep.
And I'm curious, this is kind of like looping back to earlier, but since we talk about speed, put offer in 24 hours and under contract, from the time it was accepted to your closing, what's your approximate, just contract length on doing a deal like this?
When we put it under contract, it was 21 days for inspection, which is fast. I mean, I've seen on properties this size up to 45 days. So 21 days for inspection and close 30 days after that. Okay. Due to COVID, appraisals and third-party inspections and banks are just moving a lot slower, and they're a lot more conservative. Instead of doing, loan committee every week or sometimes twice a week, now they're doing it once a month or, once every 2 weeks. So I think we're going to close the first week of August, sometime in August.
Okay.
So it's still fast as we can go, but much slower than I think what people are used to pre-COVID, for sure.
Because of the COVID
That's just how the market's moving right now, yeah.
Okay. Now, we'll get into more details. I know we'll pull the financial model because I want to talk about that, what's your game plan, the work, the numbers, all that. But before we do, I want to loop back around with you about the financing, because this is where it gets so interesting. You got your financing for takedown. I imagine you guys are doing a refi some point in the future. But talk to us about what you're on the finance side.
Yeah, sure. So, Terrance will kind of bring the deal to me with as much information as he has from the seller or the seller's agent. And so to start out, we got a multifamily model for a value add strategy. And, I'll have maybe 20% of the information that you need, for full due diligence. And so we'll go through and input either assumptions or actual data, preferably more actual data than assumptions. Assumptions always need to be more conservative. More conservative, the better.
Yeah.
And then we have basically an expectation from our investors on their internal rate of return. What the deal would have to look like to even raise an eyebrow as an investment project.
So you're doing the full underwriting with investment returns before you go to the bank, right? That way you know all your numbers.
That's right.
Okay.
I'm going to assume, based on the other deals that we have in the pipeline, our key bank relationships I'm talking with every single day.
Okay.
So I stay pretty current on loan to value, interest rate, terms, prepayment. I can guess essentially, and I always guess on the side of conservative.
And one more question. You kind of talked about your investors have certain IRRs they're looking for.
That's right.
What's do you have a go-to IRR you're using? Or
we do, and it's fluid. It's constantly changing.
Okay.
It's in relationship to investors' alternative investment options.
Yeah.
So if the Dow is, giving an 11 and we pitch them on an 11, they're going to probably turn that down because equities are, have a lot more liquidity than a real 5-year real estate investment, obviously. So, they most of our investors spend a lot of time on where to put their money, and it needs to be a valuable investment for it to be tied up until the refinance or until the disposition. So,
you mind me asking, like,
absolutely,
IRR
absolutely. So right now, a deal would be between 14 and 18.
Okay.
And then obviously north of that is outstanding.
Yeah.
Yeah, the thinking there, Chris, is basically you can go into the stock market, you can find bonds, and there's certain things between 3 and 7, that are pretty liquid. That some REITs are paying 6 or 7 or 4 or 5, and they're liquid. Now there's risk on downside, and then you can go and do institutional grade things between 5 and 8. And so when you're doing value add real estate where there is some risk and there's some market risk, and with the workforce housing and this kind of demographic, and so we've seen deals anywhere from 11 to 13, just based on my past experience of doing my deals with my own capital. It doesn't really make sense for us to do a deal if it's less than 14. Okay. So that's kind of our, the lowest denominator that we'll do is if it's a 14, and we would do that if it was Congress Park, City Park, Cherry Creek, or just a Rhino, or a really core Denver neighborhood that we really believed in. Then we would kind of go down to a 14. This being Wheat Ridge is just on the edge of what I would say is a really great walkable neighborhood that people are going to pay a premium for, and it's always going to be full. So that's why on this one we're going to need to be towards the upper end of the spectrum on that.
Right. Okay. Our peers play a role in that also. You have to look at what other people doing the same exact thing we are. What their returns look like as well, because your investors are looking at that as well.
Oh yeah, you got basic alternative investments out there.
Right. So from there, if we're still things are looking good, we'll start thinking about financing. And so in the finance world, you've got kind of regional banks or credit unions, state level size banks, which would be all through Colorado, maybe into Wyoming, Iowa, and then you've got your national Chase, Wells Fargo, Bank of America, and so each project or each bank is the right fit for the right project. You're not going to want to flip a house with Wells Fargo probably, because it would be pretty hard to get a loan, and you're not going to want to build a baseball stadium with a regional bank, because they just simply won't do it. And then for deals between 3 and 5 million, you're getting into the agency availability, which is Fannie and Freddie Mae. You have to go through a broker, and so we have relationships with 3 or 4 brokers. And so what I'll do is I'll kind of put out the model to 4 or 5 people, at a range from agency to the regional banks.
And so it'll be across the whole spectrum to see who's getting the best rates at their...
That's right.
Okay.
These are really key relationships. It's not just a customer service line, someone on the bank. It's a banker that, Terrance and I have had lunch with. We have typically done previous deals with.
And are you sending them your spreadsheet, and I'm assuming some type of summary page in your email, or how much detail are you getting for that first level? Just, hey, what's this look like?
I do. I send them the summary page from my model, and then they're I already know they're going to come back requesting the seller's financials. That's the main thing they want that we're up against. Is we're saying, Terrance and I are saying, we can make this asset perform at this level. Look at the returns it's going to yield. Look how easily we're going to be able to make our principal and interest payments. There's no doubt about it. You're at no risk. We're going to crush this. And they're going to come back and say, Ben, send me what the last owner has been able to do, and we'll...
no bank takes that line. You're at no risk.
Right. That's right.
Just give us the money. Just wire it tomorrow.
That's right. So they're highly concerned with what the seller has been able to, how he's been able to perform over the past few years. So... you always hope that they have pretty, they've been keeping financials, because that can be a problem if the answer is
a lot of sellers
he said he's made a couple dollars.
Yeah.
Right. Okay, so from there, we get the term sheets back, and we'll narrow it down to 3 or maybe 2 options, and then on each term sheet, I'm looking at the rate, the term of the loan, the prepayment penalty, the personal guarantees, the loan fee, and then there'll be a debt service coverage ratio requirement. And so based on the deal and our business plan, which maybe is hold, acquire, remodel, refinance, hold for 10 years, is going to be you're going to want a different lending structure than if you're going to sell it immediately after the remodel.
So what's the high-level game plan here? Obviously, you guys are taking it down, you're remodeling it, but
That's right.
What's the high level look like, just for like the punch list and the timeline?
Yeah, so we raise enough money. We raise enough money for the equity, and most of the time our investors are risk adverse, high net worth individuals that are looking for stable cash flow. So they're not looking for max leverage. So one of the differences in my former life, where it was just my capital and I was doing deals with just my company, no outside investors, we were max levering everything. So we were getting 80, 85%, 90% of total cost of the project. And in this world now, post-COVID, trying to be conservative, we're doing as little leverage as possible. So we're probably going to do somewhere between 60 and 65 leverage on the purchase, and we'll bring all the equity for the construction. And this just lowers the risk profile, knowing that you're always going to be able to cash flow even if something catastrophic happens. And so that's good. So what's nice is now it's not all of my capital, so there's other people involved, and so we can do more deals, but just less risk in the deals, just much more conservative, so we protect the downside.
Now, I was curious because you mentioned, one of you guys mentioned earlier, just what kind of other investors and your peers were doing. I don't see a ton of like syndication stuff, but the ones I've seen, a lot of them aren't doing a 60% LTV. It seems like you guys are going for a lower LTV. Is that a correct assumption, or is that incorrect?
Yeah, it's just risk. We know our investors pretty well. They're just some conservative guys around town, and they'd rather have a little bit lower IRR, but have much less risk.
I'll say if you're getting an IRR with that type of LTV, that's even more impressive.
It's good.
The higher the leverage, usually the
higher the return. That's right, because you need less cash.
Yeah.
So we're going to raise a little bit more cash here. So then since it's 25 units, we're going to try and do 2 a month. So we think within 14 months, we'll have the whole building turned. Again, when you have LPs, we're going to try and distribute cash every quarter. So previously, I would probably empty a fourplex or 2 fourplexes at a time, go in there, renovate them all, and have zero cash flow for 6 to 8 months, or very little cash flow. But then I'd have the whole thing turned a lot faster. Now with LPs, we're trying to show cash flow, distribute every quarter. So we're going to do a lot slower, but we're going to have income along the way. So then at the end of the 14, 16-month period, we'll then take this property. The rents will be increased. The NOI should be up 30, 40%, depending on how things go. And then we'll be able to take this to one of our agency brokers, and Ben will say, hey, here's the new NOI. We've taken a lot of the risk out, virtually like everything's stabilized now. So now we'll go and get another loan. We'll refinance out. We'll return probably 50 to 60% of the capital of the upfront equity back to our investors. And we'll recap the project. We'll get it at a lower interest rate. We'll probably get some interest only for 2 or 3 years so that we can even distribute more cash. And at that point, we'll just hold it. We'll just be able to clip coupons and have mailbox money. We'll have our market tenants in there. Should have very little maintenance. Everything's been turned. We've fixed the roofs, done the soffits, the gutters, the boilers, the hot water heaters, basically everything that we found on the inspection report. We're going to probably add an amenity, something for kids to attract families. We may even add some garages or storage with the back parcel there. So at that point, we'll have just a fully completed project, much less risk. We'll be able to take that, shop that. We'll have probably multiple term sheets. We'll be able to put them against each other and get a really attractive agency non-recourse loan at that point.
And I'm assuming at some point you'll probably exit or sell in the future, right?
Absolutely, yeah.
And is that roughly like 5 years out, 10 years out, or is that to be determined?
This will be a 7-year hold,
okay,
as we have it now.
Great. I know we'll dive into more numbers, so I just want to recap this as we get back to financing. So you're buying it now. You'll be around a 60 to 65% LTV, going with I say probably a local bank loan for 1 to 2 years.
Right.
Rehab it around the 2-year mark. Once it's up, it's stabilized. You get some operating history. You'll then do a non-recourse agency debt around the 2-year mark.
That's right.
IO for a couple of years, and then sell around year 7 from when you buy it.
That's
okay.
Right.
That's the plan. And obviously, if we get a really attractive offer, in a couple, 3 or 4 years, and our LPs really want to, take some chips off the table, we could do that and 1031 into another deal. But yeah, the plan is, and once we've done all that work and we've de-risked the project, at that point we want to kind of be able to let that accumulate some yield for our investors and really, and pay us back. So, that, kind of similar to what I've done in Des Moines, where we've done a lot of work on properties, we've refinanced, and now they're just cash flowing. Once you've done all that work, you want to, and on this size of a project, you really want to kind of reap the fruits of that. So we expect to hold this for 5 to 7 years.
Okay. Yeah. So going back, go ahead.
One component that makes that strategy so attractive is your acquisition loan's at 65% of the value. Then you're gonna rehab it and increase the value, and then the agency's going to give you 80%. So not only is the amount of debt that you're able to have going to go higher, but it's off of a new remodeled value. So we're able to return a lot of equity to the investors, so they're getting the majority of their principal back and still enjoying their distributions for the life of the project.
Okay.
So that's why that acquisition loan followed by an agency loan is so common, because the agency will go up to 80%.
And what type of a loan are you guys getting for the initial takedown loan?
It's the banks would refer to it as an acquisition loan.
Okay.
I don't tell them that they're going to get refinanced out, but when I say prepayment after 1 year is not an option, they see the cards.
They can figure it out.
They know
right?
what's going to happen.
Yeah.
That's fine with them.
So you always go for 0 prepayment after year 1?
In a business plan like this, that would be critical.
Okay.
Depends on the size of the project. Obviously, the larger the project, the longer it's going to take us to rehab it, and so then the prepayment may get bumped out. But the bank's going to make, they're going to have an acquisition fee up there, and they're going to make a good spread. I think they're probably getting money from the government under 1% right now, and they're lending to us in the 3s. So, they're going to make good money, and we've done a lot of business with them, and so we're able to.
And they're going to compete for that refinance. So
That's
they're
right.
not out. They're not.
Oh, yeah.
It's not like they're losing the deal. They'll be looking to be the lender on the refinance also.
So what type of terms did you get for this on the takedown? We can ask like the rate and the
Sure. So we got
all that.
at 65% or 65% LTV at 3.85 for 1 year of prepayment, which is irrelevant to us in this business plan. That's a 5-year fixed term, and it had a 1% loan fee and a personal guarantee that will be eliminated once we hit a 1.4 debt service coverage ratio.
Okay.
So that's simply your income divided by the sum of all debt payments, regardless if it's with the bank. That bank, you have 2 or 3 notes on the property, you have to be over a 1.4. So when you hit that 1.4, the individual or the individuals that guaranteed the loan are released from that guarantee.
Okay.
So in this project, once we restabilize and re-rent at the higher rate, that should be very achievable.
And one thing to know, for listeners out there looking to buy multifamily is, in a pre-COVID world, lending was much easier for commercial properties. I think single family, it probably hasn't changed much. So if you're under 4 units, that's more your world. But I'm guessing that hasn't changed as much, unless you're going jumbo. But in commercial, it's changed a lot. It's a lot more difficult. With our track record and our personal balance sheets, lending hasn't been an issue the last couple of years. But in the last couple of months, it's been a lot more difficult. Even with the history that we have with some banks where they've seen us, execute over and over, they're still being, just because of their board and their underwriting and, just their internal regulations, much more scrutinized. Every single line item, every rent roll, they want to know the tenant history. They're asking a laundry list of questions that we're just not used to. So it's been a lot more difficult. I would say that, for people out there that want to get started, you should probably connect with someone that's an existing operator that has some banking relationships. I'm always trying to put myself in the position of someone that's listening that's wanting to get in or wanting to transition. And I think the punchline for them is it's probably going to be difficult to get a loan right now. Banks are only lending to people that they view as like experienced operators. Even with agency, debt, Freddie and Fannie, as Ben mentioned earlier, you're having to put 12 months operating reserves into an account. So on this loan, they were going to make us put $180,000 in an account. So we were going to have to raise an additional $200,000 just to stash away because they want the reserve account in case tenants don't pay. And so what that means is for people, you have to have a lot more cash, a lot more experience, and that's even for people that are approved, that already have the experience. So I just think the one thing that I've learned, and I think I think we have a blog post coming out on Bigger Pockets about this, is just lending in a post-COVID world is a lot more difficult. And I think the punchline is lenders are much more conservative. There's a lot less capital chasing these deals, and they're looking for experienced operators that have a track record, and then on top of that, they're going to underwrite the property very, very, under a really large microscope, every line item. And that's new to me. I mean, in the last couple of years, the market's been going up and there's been no issues, no pandemic. I mean, everyone's been making so much money. Lending was pretty easy, but not in the last 2 or 3 months. It's been a total shift in our conversations and the tones from banks. And, I mean, half the banks we talked to said they're not even lending on multifamily the rest of the year. They said that they're just not, they're shutting it down. Basically, and they told us that. I'm sure that they have people that they're not saying that to, but they just said, the leverage that we have no leverage for multifamily right now.
We've had a couple newer clients buying, between like 5 and 15 at multis right now, and we just got rung through the ringer. Like we found some good terms from banks, but it was a lot more difficult than it was 6 months ago. And these are people without your experience and track record, Okay, so let's jump in the financial model here, because I know we're running up on the hour soon. So Ben, I'm on the right slide, right?
Yeah.
So this is your wheelhouse, and this is basically just a screenshot of Excel spreadsheet that we can put on the blog post so people can follow along with us. But walk us through the numbers here, and tell me if you need me to move anything so you can point to it.
Sure. So this is, I have the assumptions page, which I was referring to earlier, which I basically just put in all the information that I know with the rents. It has the fees, the rents, the operating cost, everything from insurance, utilities, to all the loans, basically every single thing that makes up the deal. And then it takes every single month from, over the 7 years and basically pulls what I told it and just runs the financing for the whole 7 years, every single month, to include, increase for expenses and income, assuming rents will go up and costs will go up.
What's your percentage assumption for expenses and rents?
We underwrite an accelerator of 3 on income and a 3 on expenses, which, you can see does almost little it does 0 to your NOI. Obviously that won't be the case. The market will have either rents accelerating faster than expenses or vice versa. But to be safe, we just run a 3 and 3. And so it runs the whole model for the whole 7 years. And then what you see on the screen is kind of the annual. It's just taking 12 months at a time and showing you the sum of the 12 months divided by 1,000. These numbers are in hundreds of thousands. So up at the top, you see inflows from rents and RUBS going across, and then the expenses, and then your NOI. So that's just your income minus your expenses for all 7 years. And then on the far right is just specifically the sale.
Let me clarify, because I really like the way you laid this out. Because on this first section you're talking about, you got the operating expenses and you got your total rent revenue and the total operating expenses, but those are not rehab costs, right? Those are normal insurance, taxes, maintenance, property management, all the normal just operating costs, right?
Yeah, you'll see rehab down in capital items.
So I'm going to read a few of these off so people
absolutely.
can. So like in year one, this is when you're taking down. Total revenue is $273,000.
Right.
Total operating expenses around $86,000, leaves you approximately a $187 NOI. Year two, and it sounds like partway through year two, you should be fully rehabbed and leased up. So you're at $375 revenue. So you're at like a $100,000 jump in revenue. Your expenses go up about $14,000 to $100,000, and your NOI goes from $187 to $275. Now year three is when you're fully stabilized and good to go. And so you have a full year's worth of, high rents and normal operating costs. You're at $415,000 revenue, 105 in operating expenses, and then 309 in NOI. And every year after that, it's just basically you're that 3% increase, right?
That's right.
Okay.
So what I'm looking here is not only does the NOI need to go up, obviously, as the years go by, but the spread between income and expenses needs to be growing at a faster rate than the year before, which means we're increasing margin as time goes by. If that were not the case, you might want to sell previous to the pro forma year. So not only do we want to grow, but we want to be growing at an increased rate incrementally from year to year. So we moving down. These are expenditures, not related to operating expenses, which are your taxes, property management, so on and so forth. So this is the actual development. So we purchased obviously in year one. So that's a large negative number, and then throughout year one and year two, you can see in development soft costs, we're spending money on rehab, and then way out in the sale, the property sold for $5.6 million. So pretty basic.
And so you're basically assuming roughly about $200,000 in year one and $200,000 in year two for all your development costs.
That's right.
Okay, and I see you have soft cost and hard cost.
That's right.
These says soft cost. What's the difference between soft and hard?
Hard is the easiest way to think about it would be the labor and materials that you could, items that could be purchased at Home Depot plus the individual who's going to install it. Soft costs would cover legal, underwriting, the engineer's bill, the architect, accounting, our overhead.
So you just have these lumped together for
that's right.
simplicity? Okay.
This is a draft, so that there are hard costs in there, obviously.
Okay.
We just have them both under.
And then year 7, you got your sale at $5.65 million.
And that was what, Ben, a 5 3/4 cap or 6?
It's a 5.75.
Yeah, so we try to be conservative.
Too.
Yeah,
If there's ever a number to be conservative on the whole model, that's the one.
Yeah, I'd say and good chance, assuming things are the way, you'll probably be in a low 5 cap rate at that exit point.
Which
would make your sales price go up,
absolutely
increasing your investors' profitability.
But again, under promise, over deliver. So
yeah,
that's right.
Yeah. We've done 6 actually in some pro forma 6 just to be ultra conservative. So
we're moving down now. Just 2 bank loans over the course of the property. That's 65% LTV to acquire the properties, $2.5 million.
And that's that first one, 2.5. That's the takedown loan.
That's right.
Okay.
And then we refinance at a 6 cap of the new stabilized income at 80% LTV through agency, and so we bring in another $4.1 million and make a sizable payment. You see down there in principal payment to the original bank loan.
So this payment of $1.68 million, that's going back to pay off the first loan.
That's right.
Okay.
That's right. And so this is just breaking down, the financing flows. Interest goes throughout the entire project, which is another conservative way to look at it. Hopefully there's some interest only after that we get on the second loan, but we're not going to count on that.
What did you underwrite the agency interest rate at?
3.8, which is what they quoted us for an acquisition. So it's good that you brought that up because it's 2 years from now. So it's, who knows what could happen in 2 years' time. And so in the bold total financing flows is, just the major movement of money between the bank and the investors. DSCR, which we already talked about.
I'm sorry. What do you mean? I don't follow you on there. Like
total financing flow is just the sum of the rows above it.
Okay, so that's paying off the loans, and the money you're bringing in.
That's right.
Okay,
that's right.
Because I know
as an investor, I'm going to be curious when Terrance and myself, as the operators, have an abundance of cash. What's the priority going to be? Is it going to be to me to pay me back a nice, healthy return so I can make as much money, or are you going to prioritize the bank? And so that total financing flows is going to basically, you could match up against net LP cash flow and understand, all right, these guys are making a ton of money, but they're not, they're just worried about paying down the principal as much as they can to the bank and not distributing income to the investors. So that's why that's investors are always curious about that.
Okay.
DSCR, again, is the debt service coverage ratio. And then total developer fees. Obviously, investors are going to be curious, well, how are you guys compensating yourself? So that's those numbers are just the annual sum of everything we receive, which in the early years is a management and a development fee. There's an acquisition fee in year one. And then you see that we go down to 35, 35, 35, 44. Once it's stabilized, we're just taking a management fee.
Okay. So that's just all the fees lumped into there.
Yep. That's net compensation to the value add real estate company for their efforts. Net LP cash flow is distributions to the investors. So you can see obviously in year one there's a negative number because that you invested.
And that's the amount they've invested about 1.7 is what you guys have raised?
Yeah,
okay.
That's right. At the end of year two, there was a refinance where we basically converted investor debt to the agency. So we, at that 80% LTV, we were able to take a cash out refinance and pay back a lot of the investor equity. That's why that's such a high number. So when we talk about yield, now the investor's basis in the investment is generally low. It's 50% of what it was, or even more than that.
Okay, wow.
And so myself, if I'm looking at investing in this deal, I'm thinking about a risk and return. So I see, wow, I'm getting a sizable amount of my at-risk dollars back in year two, but I get to redeem income for 5 more years.
Yeah, I just realized, you're pro forming almost just $100,000 less than what they'll be putting in. They'll hopefully be distributing in year two.
That's not completely principal. That 1.7 has earned us an 8% preferred return over that year, which we will pay off before we pay anything else. So this investor, to the same point, he's got a lot less. He or she has a lot less dollars at risk, but is enjoying this, the returns through the life of the property. And so it runs out, and you can see the distributions to the LP all the way out into the sale.
And this final one is the cash flow plus the sales proceeds, right? For this LP cash flow.
That's right.
1.2. Okay.
That's right.
So I know we're covering a lot of numbers on here, and this will definitely be on the blog post. So listeners out there, go click on the show notes links, and this is one of those things where looking at it is much easier than us trying to describe it. But Ben, you did a good job of laying this out, so this was very helpful. I want to talk to you guys, if we have time, about just the way you structure like the returns to your investors or stuff. Can we dive into that?
Yeah, let's talk about it.
Yeah. And we can scroll down into, it's this section, right? The structure you have. Yeah. So LP limited partner, GPs, you guys, a general partner. Just high level, walk me through the structure on this, because this is one of the areas I am not an expert on.
Yeah, and up until 6 months ago, I wasn't either. I think, the big punchline for this, Chris, and everyone out there, is that basically, I could do this project. I could go and try and liquidate a bunch of things and then try and do this on my own, and I'd basically get no fees, and I'd just live off the income of the property, and I'd have 100% of the upside. And so naturally, as we're trying to grow and scale and take our business model and apply it to more properties, we can bring on other people as LPs. And so what that does is it extends and kind of leverages our ability to do more projects with the capital that we have. But we need to get paid for our effort of doing it. Yep. And so the way to do that is to split up the project. And what we've done, just through a lot of research and talking to some institutional investors around town and looking at people, other operators around the country, is a 70-30 split with the LPs and the GP with an 8% preferred return. And basically in English, what that means is that if the project nets $1 million, right?
And this is cash flows and sales proceeds, right?
Everything.
Okay.
That's right. So if at the end of the project there's $1 million, the 8% pref gets paid first. So if I put in $100,000, I'm going to get 8% preferred every year, right? So 1 year, 8%, I'm going to make $8,000 of a pref of interest. I get that back, so I pay all the LPs 8% on their money. After that, we split the profits 70-30. 70 to the LPs, 30 to the general partnership.
So that $1 million, you subtracted all the 8%.
That's right.
Returns, and whatever is left over from there.
You split it 70-30.
$900,000, then it's 70-30.
That's right.
Okay.
And then we get paid a fee for basically acquiring the property. So just doing all the due diligence, all the homework, getting the bank financing lined up, being able to close on the property. So we get a 1% acquisition fee, which is roughly $3.8 million, $38,000. And then we get paid a 1% disposition fee. So we've done it both ways, where we take a larger acquisition fee up front and then no disposition fee. On this project, we decided to split it up and do a 1% acquisition, 1% disposition, because there is a lot of work just to source the property, underwrite the property, get the loan, do all that. So there's a fee that's paid to the general partners for doing that. And then same thing for selling it, is getting this project in a place where it can be sold so everyone can have a windfall at the end. And then development fee is just on the construction. And so basically we just take all of our expenses and then we'll charge a 5% fee on top of whatever that was, which ends up being very nominal.
And that's for like the redevelopment cost.
That's for all the redevelopment.
Not the operating cost, but just the redevelopment. So
it's just the construction,
okay.
Right. And then on an annual basis, the management fee of overseeing the property management, of making sure the LPs have all the paperwork, get their distributions, making sure the banks are satisfied with all their reporting. So there's a fee for that annual, and we just make that fixed. On these smaller deals under $5 million, we just make it fixed, somewhere around 1% of the purchase price. This happens to be a little bit lower than that. So pretty simple, pretty standard. It's pretty competitive. I think, looking at, we wanted, Ben and I and our team, we wanted to be able to provide a great service to LPs and to our investors and really our partners. And so we tried to make something that was very conservative towards the GP and very LP friendly. Obviously, we've seen there's different waterfall splits where you'll see like over a 15% return. GP then takes 50% of the upside, and we are just going to stay 70-30 regardless of what return. So if we end up hitting this out of the park and returning 30%, the LPs are still going to have 70% of the upside.
Yeah. That's great. You did a great job explaining that, because that's a lot of stuff to go there. And this is kind of like the model you guys are. We're
going to do this every single one. Yeah. Okay. I mean, I think in a couple years, once we have some exits and we're able to show a track record from this model, then things could change. And if we have a track record of our last 5 projects all returned over 25%, and then at that point we'll probably adjust it some, because we'll just have a lot of.
Would that be more likely just like the GP-LP split? Is that how they normally
We'd probably adjust it and probably do like a waterfall after a certain return.
Okay.
Or maybe have a higher acquisition or higher asset management fee. It's just supply and demand. Right now, as we're kind of getting started, proving ourselves, even though, I do have a large track record of my own projects, I don't have a large track record using other people's money.
Yeah.
And so as we're building that up, there's, obviously there's a balance of supply and demand, but obviously as we have more demand for the projects, then the splits would most likely turn. But they would still be, I think, just in my general nature as our company name is just value add. We're looking to drive value to our LPs and to our partners, and so we're always going to try and err on the side of being LP friendly.
All right, so this is great. I got a couple quick questions here as we wrap up. So I know this question will come either to me or you guys, but let's get on the air. Can people invest in this particular deal?
Yeah, so we have to be very careful here. But this project is already in the can. We've already raised the money.
Okay.
But we're going to have other.
So no to this one.
No to this one.
Yep.
In the future, there's going to be other projects very similar to this. I mean, basically every deal that we do is going to be about the same as far as like the profile. Maybe have different neighborhood, different address, different unit count, but it's going to be the same story. It's going to be something that's 30 or 40% under market rents. We can come in there, renovate the project, give it some new life, and increase and drive NOI to increase returns and create distributable cash flow to our partners. And so that's going to be the storyline. This particular project, because the dollar amount was so low, 1.7 million, it was basically going to be made up of like 8 to 10 LPs. We're going to be one of them. And so there's this deal is not going to be available, but there will be others in the future.
Okay. Now, if people want to, because I know we talked about this before, if people want to get in touch with you for this, what are you looking for, and how should people get in touch with you?
Yeah, so thanks for asking that, Chris. So I think the three things that, if people want to get involved with us are, obviously we're always looking for new opportunity. I spend a lot of time, with you. We do marketing, we're doing podcasts, we have a ride-along show. We're always building relationships kind of at scale with people all around the state and the city. And so, I think people that have opportunity, other value-add multifamily projects, we're looking to do, 5 to 10 of these a year that fit this same profile. We have quite a bit of cash on the sidelines, and we have, a pretty long list of LPs that want to do projects like this. So we're looking for new projects, 20 to 100, 150 units, value add, core Denver. That's one way. I think the second one is contractors. We're always looking for new contractor relationships as things have kind of slowed down on the new development side. I think that there's probably some good talent on the sidelines that wants to, if they want to work with a reputable firm that is going to have a lot of work through the winter and year round. So we're always looking for good contractors. And then, we're looking for strong LPs. I think, we're going to build this business on having a really streamlined process of LPs that know our process, that are looking to get into multifamily, that understand it, and that want to invest in Denver. I think one of the reasons why I decided to go this route of syndication versus just using my own capital was, everything I was seeing out there was, Atlanta or South Carolina or Florida, or all these bigger, markets in the South where there's, all these big opportunities but nothing really in Denver. I think most of the storyline in Denver is that there's no deals, there's no multifamily. It's appreciated too much, and you can't get the return. And I think that we're telling the story that, hey, there's a lot of opportunity here in your backyard, and we can offer these investments to investors in Denver that are looking to buy multifamily, as a lot of people are. And you don't have to go to the southeast or the northeast or go to the south. You can buy Denver multifamily, and we just want to be an option for people that want to stay in Denver and be able to go and drive their friends and their family, buy in a building and say, hey, I'm a partner in this, and they don't have to go out of state. So that's what we're doing, and we're looking for strong LPs that can help us continue to execute that plan.
Cool. And so we'll put, I know you guys in the process, you said earlier, just kind of updating a section on our website to help collect the information. That way you guys can reach out to people. So once that's complete, you'll email to me. We'll definitely have that in the show notes once this goes live. So if you guys want to reach out to Terrance with a deal, contractor, or to invest, check the show notes. The link will be on there. If for some reason I forget to put it in there or you can't find it, email me, Chris at Denver Investment Real Estate, and I'll definitely make sure everyone gets connected. All right, Terrance and Ben, I know we're just running over an hour here, so I want to be respectful of you guys this time. Any final thoughts or things that you want to mention before we hit the stop button?
No, that was great. I'm glad Ben was able to join me on this. Hopefully he'll be a regular here as we underwrite more deals, and we popped his podcast cherry. So that was a good day. Is that too much for you? He's speechless.
No.
He's speechless. I think it was.
It was too much. It was too much for the former Navy SEAL.
No, this was great, guys. I enjoyed it. Again, I mentioned in the beginning, this is something we'll be doing. I think, we're shooting for once a month as deal flow comes in, because it's a very different side to what we're investing in, a great investment. So if you guys have feedback or more specific questions, email me, let me know, because I do a lot of these shows for myself to learn, and also it's just great for other people to learn and network around here. So guys, thank you.